Ever hear the rumors on how the rich don't pay taxes? Well, in some cases, it's more than just a rumor. Find out the incredible benefits of real estate investing and what that can do to your tax situation. In this video, I walk you through real estate depreciation and two other powerhouse strategies used by some of the world's best investors. Let's jump in. Now, I'm not a CPA and I don't pretend to be one on TV, but I am an investor myself, and I've deployed a significant amount of my personal capital into real estate. I've acquired a lot of knowledge from working with professionals and industry leaders, and I'm going to pass that knowledge down to you. Hopefully you can take that information and speak to your professional team to see how it can be tailored to your specific situation. So why does the government incentivize real estate investing in the first place versus other vehicles like stocks and bonds? Well, let's take a look at the big picture. Every time a housing project is going to get built or an apartment complex is going to get renovated, there's a huge ripple effect on the economy. There's jobs being created, materials being purchased. Therefore, it's in the government's best interest to incentivize investors to participate in this asset class. Secondly, there's a major housing shortage, especially for affordable housing. Now, one of these tax benefits that the government offers is called depreciation. The government recognizes that things deteriorate over time, especially from wear and tear. Think of your car or computer. Was it worth more when you first bought it or now? It was probably worth more then. However, real estate typically increases in value due to factors such as inflation, supply and demand, and a growing population, just to name a few. So they say, okay, we understand your building is getting older, and even though it might not actually be losing value, we'll allow you to act as if it is. This is why this is considered a non-cash deduction. We mean it's the type of deduction you don't actually have to spend any real money or have any losses in order to claim the deduction on your taxes. If you're a passive investor, these deductions can apply to some of your other passive income streams, not just with the real estate project in question, but even from stocks and bonds and other vehicles that you're invested in and don't actually actively participate in earning that money. So let me give you a hypothetical example of how depreciation could look on your taxes. First, we need to understand there's two schedules. There's a schedule at 27 and a half years and one at 39 years. Essentially, this is saying that the property is deteriorating from wear and tear based on either this time frame or this time frame. And 39 years is used for commercial properties, and 27 and a half is going to be used for residential properties. So an example of a $10 million apartment building would look something like this. We would take $10 million, and the first thing that we need to do is subtract the land cost. So again, hypothetically speaking, let's say the land cost is about $2 million. We would have $8 million that could be depreciated by, in this case, 39 years. So in order to see the tax benefit, we would divide 39 into 8 million, and we would get $205,128. Now let's say you are a passive investor that participated in this deal and you put in a $100,000 contribution. This $100,000 should give you 1% ownership of this property. If you have 1% ownership, you could claim 1% of this overall tax benefit, which is $2,051. The actual loss you can claim also depends on the property's net operating income, your total income. This is why it's so crucial to speak with a CPA, an attorney, and take this example, see how it can apply to your specific situation. Now let's jump into one of the powerhouse strategies called cost segregation study. This study requalifies parts of the property to categories that can be depreciated over a shorter period like 5, 7, or 15 years instead of all over 39 years. By identifying items that can depreciate faster, you can claim bigger tax deductions sooner. This lowers your taxes in the first few years after the investment is made. This $2,000, after a cost segregation study is performed, the total value of $205,000, some of these items in the 39-year schedule can fall into the 5-year bucket, 7-year bucket, 15-year bucket. And this number now for the first couple of years could be $300,000, could be $400,000. That really depends. It's going to vary based on what the study comes back with. So a cost segregation specialist would be hired. If you're a passive investor, then the sponsor would handle all of that for you. If you're an active investor, you would need to go and establish some relationships with cost segregation companies that can perform this type of study and help you maximize tax benefits in these first few years. The second powerhouse strategy I want to talk to you about is called bonus depreciation. And it falls under this cost segregation study that we just discussed. However, instead of being able to deduct certain items in 5, 7, or 15 years, there are going to be parts of that report that you can fully deduct in the first year of ownership, which leads to massive tax benefits in that first year that the investment is made. So why do people want to use some of these depreciation benefits and expedite depreciation with cost segregation and bonus depreciation? It comes down to the time value of money. Let me give you an example. When was a Coca-Cola worth more? Today or 10 years ago? It's much more expensive today due to inflation. So as time goes on, the buying power that your dollars produce becomes less and less. So the concept is you want to have that money available to you today, and it's not going to be available to you today if you're paying it to the IRS. Think about it like this also. If you can save, for example, $10,000 for money that you would have to pay this year, you could put that $10,000 into stocks, bonds, or even more real estate. Now that money is making you money as opposed to being a payment to the government. Now, caveat to all these depreciation benefits is something called depreciation recapture. And this is the process by which the IRS collects taxes on all or part of the depreciation deductions you claimed while you owned the property at the time when you sell it. Essentially, it recaptures some of the tax benefits you've been getting along the way. This is why it's so important to talk to your CPA, your attorney, your estate planners, and find out how you can navigate that landscape, because there are other powerful strategies that can be combined with depreciation to really offset taxes. For example, opportunity zones and 1031 exchanges. And if you'd like to learn more about some of those tax benefits, feel free to book a call with us. And again, we are not attorneys, we're not CPAs, but we are real life investors. We put a significant amount of our own money into commercial real estate, and we study these things. So we would love to pass down everything that we know, and hopefully you could take that information and discuss it with your professional team to see how it can be tailored to your specific situation. Book a call with us today.